When you're just looking at the price of something, you're not investing. I mean, if you own stocks like you'd own a farm or apartment house, you don't get a quote on those every day or every week. And I think you look at the business, and the value of American business depends on how much it delivers in cash to its owners over between now and Judgment Day, and I don't think it changes in 10% in a 2-month period if you're looking at it as a business. Anything can happen in markets. I mean, anything can happen in markets, and that's why I say don't ever borrow money against securities. That markets don't have to open tomorrow. I mean, you can have extraordinary events. So I think to some extent you can get some of the instruments that people don't understand very well that have the idea of people taking a position, and they're gambling. They're not investing. Nobody's investing when they buy, some supercharged index on, on how the VIX does or something like that. Need it in their life. It's an unnecessary instrument. They will create instruments that the public will buy, and you can just count on that. Wall Street's been doing that since they met under the buttonwood tree in 1792 or whatever it was on the exchange. So, but if you're investing, I look to the business to determine whether I made a good investment. And I'm concerned about, whether we have new competition, how we do over the years. But it's the business I look at. When you're just looking at the price of something, you're not investing. I mean, if you buy something, Bitcoin, for example, or some cryptocurrency, you're not looking to the asset itself to produce anything. If you buy an apartment house, you're looking at how the apartment house does. If you buy a farm, you're looking at the farm does. If you buy a whole business, you're looking at how the business does. If you buy a part of a business, why shouldn't you look at how the business is going to do? But people get charmed by lots of action and the fact that things are liquid and all of that. And it does have repercussions back into the market when you get something like an ETN arrangement on the, supercharged on the VIX. I mean, where you can lose 90% of your money in one day. I mean, that really doesn't belong with the word investment. I mean, it's a gambling. You can buy small pieces of businesses for less than you can buy whole pieces of business. So you get a bargain as an investor compared to what I can get in terms of buying the whole business. And people, if they just think of stocks as pieces of business, they'd be so much better off than thinking of those little things that move around in price. And I think with Berkshire, we have an unusual number of people as shareholders who just look at Berkshire as a business. They look at it as a savings account. They put some money in 20 or 30 or 40 years ago. We retain it and reinvest for them, but we're their savings account. And that's the way I look at my own stock. That's the way Charlie looks at his stock. I buy a 30-year government bond. It has a whole bunch of coupons attached. In the old days, it does now. It's electronic. But it has a whole bunch of coupons. And the coupon says 3% or whatever it may say. And that's what you're going to get between now and 30 years from now, and then they're going to give you the money back. What is a stock? A stock is the same sort of thing. It has a bunch of coupons. It's just they haven't printed the numbers on them yet. And it's your job as an investor to print those numbers on. If those numbers say 10%, and most American businesses earn over 10% on tangible equity, if they say 10%, that bond is worth a hell of a lot more money than a bond that says 3% on it. But if that government bond goes to 10%, it changes the value of this equity bond that, in effect, you're buying. You are buying, when you buy an interest in General Motors or Berkshire Hathaway or anything, you are buying something that over time is going to return cash to you. Maybe a long time in terms of Berkshire, but it'll be bigger numbers. And those are the coupons, and it's up to you, your job as an investor, to decide what you think those coupons will be, because that's what you're buying, and you're buying the discounted value. And the higher the yardstick goes, and the yardstick is government bonds, the less attractive these other bonds look. And that's just fundamental economics. So 1982 or 3, when the long government bond got to 15%, a company that was earning 15% on equity was worth no more than book value under those circumstances, because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year. And a business that earned 12% was a subpar business then. But a business that earns 12% when the government bond is 3%, is one hell of a business now, and that's why they sell for very fancy prices. 2.4 to 2.9 is nothing if you're comparing it with businesses that earn 12% on equity and invest. And the S&P, you can just look at the figures for decades, has earned on tangible equity, it's earned a lot more than that, and it translates into higher prices than it should. It is gravity. I mean, if you told me interest rates were going to be 15% next year on long bonds, there's a lot of equities I wouldn't want to own now, and I would buy a lot of governments at 15, and I kind of wish I had it in 1982, but I didn't. But it's been idiotic to own long bonds during the last. I talk about this in the report in terms of it's just been idiotic, and big public pension funds and all that, they sat there and they own bonds. Now, they may have bought them on a 4 or 5% basis, but if they go to a 3% basis, they're selling way above par. The way people think about it is they do some very silly things. Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock because it goes down?
Selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along the next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they be. Whereas the longer the maturity of a bond, the more risky it becomes. It's not easy psychologically for many people, but I've been teaching since I was 21. I taught my first class on investments, and I had a class last week with 11 schools, 220 students, and some of them get it and some of them don't. People would rather gamble. I mean, the idea that you can double your money in 6 months, it's why people go to the races, why they go to Vegas, whatever it may be. They even know the odds are against them, and they still do it. I mean, it's a strong instinct to want to get rich fast. And I don't know how to do it.